Hello, everybody. Good morning or good afternoon, depending on how far away you are from the East Coast. My name is Nathan Dietz. I'm here with the Urban Institute with colleagues Tom Pollock and Jeremy Coolish, as well as our partners in this enterprise from the Indiana University at Purdue in Indianapolis' Lilly Family School of Philanthropy, and also from the Moody's. We're here today to introduce the first of 3 webinars that we're going to be making available for you about the nonprofit sector. And today's webinar is entitled Lessons for the Future, the Impact of Recession and Nonprofit Financial Knowledge. So before we get started, I'd like to introduce the moderator for today's discussion, Ms. Frances Lazarson, who's the president of the Moody's Foundation, who will oversee today's discussion and presentation. Ms. Lazarson oversees the Charitable Giving Program and Corporate Social Responsibility Programs for Moody's Corporation. The Moody's Corporation is a charitable foundation established by the Moody's Corporation. Moody's is an essential component of the global capital markets, providing credit ratings, research, tools, and analysis that contribute to transparent and integrated financial markets. The Moody's Foundation is committed to supporting education, in particular the study of mathematics, finance, and economics. The foundation also funds specific initiatives in the areas of global economic development, microfinance, civic, health, and human services, as well as arts and cultural programs. The foundation supports programs located in select metropolitan areas in the United States, the United Kingdom, and elsewhere around the world. In the interest of time, I think, Fran, if we could turn this over to you.
Okay. I would now like to introduce our presenters for today's webinar. Tom Pollock is Program Director of the National Center for Charitable Statistics, a program of the Center on Nonprofits and Philanthropy at the Urban Institute. The National Center for Charitable Statistics is the national repository of data on the nonprofit sector in the U.S. Its research includes the Nonprofit Almanac, the annually updated Nonprofit Sector in Brief, and a wide variety of research reports and briefs about the nonprofit sector. Tom's current focus is on the development of state and local civic capacity building projects. He also manages the 990 Online, a web-based TurboTax-like system for electronic filing of IRS Form 990s and state registration forms. He's published in numerous scholarly journals and has been frequently quoted in national media. Una Usili is the Director of Research at the Lilly Family School of Philanthropy at Indiana University, a leading academic institution dedicated to increasing the understanding of philanthropy and improving its practice worldwide through research, teaching, training, and civic engagement. The school's research includes Giving USA, the annual report on the sources and uses of charitable giving in the U.S., the Philanthropy Panel Study, studies of high net worth philanthropy, the $1 Million List, and a broad range of studies on giving, volunteering, fundraising, nonprofit management, and other aspects of philanthropy activity. An internationally recognized expert on philanthropy, Dr. Usili frequently speaks across the country on issues related to national and international trends. In addition to her appointment at the Lilly Family School, she is a professor of economics and philanthropic studies at Indiana University, Purdue University, and Indianapolis. Today's webinar is the first of a 3-part webinar series focusing on nonprofit financial health. Tom and Una will discuss the impact of the recession on nonprofit organizations, how nonprofits responded, and the strategies they use in financial management. Both presenters will be available at the end of the webinar to answer your questions. Contact information will also be provided to everyone. Please feel free to submit your questions anytime during the webinar. Now I'd like to turn over the presentation to Tom.
Thanks, Fran. I'm going to begin talking about the impact of the recession. So to begin, our study looked at kind of two periods in time. One from 2004 to 2008, the other from 2008 to 2012. In the fall of 2008, there were about 1 million public charities. That includes, arts, healthcare, human services, the vast majority of nonprofit organizations that we think of as charities or exempt organizations. Of those 1 million, approximately 1/4 of these had gross receipts of more than $50,000. It was these kind of 250,000 organizations that are really the focus of this research. According to federal data, the period of the recession was relatively brief. It ran from December 2007 through June 2009. The point in time that most of us think about the impact of the recession, however, was in fall 2008 when the stock market plummeted and the recession was especially sort of visible in the news. Prominent scholar Paul Light of NYU predicted that 100,000 organizations might close as a result of the recession. This study is an effort to look at the data 3 or 4 years in retrospectively and see what the actual impact of the recession has been. We were especially interested in looking at some lingering effects. We recognized that many organizations were able to kind of weather the initial impact of the recession, but there's been a lot of concern expressed that organizations may have been weakened initially and then may not have survived over the longer period of time. So our study kind of focused on comparing this 2004 to 2008 period, which we call kind of the pre-recession period, before the real impact of the recession was felt by the nonprofit sector, with the 2008 to 2012 period, when the brunt of the impact was felt. And we think in terms of sort of 4 typical responses of nonprofit organizations to the recession. If they were lucky, their revenues held steady or perhaps even increased. For those organizations that saw their revenues declining, there were a number of tactics they could employ. One is just to continue to spend at current rates or even increase spending to meet increasing need for human services in particular, and to draw down their reserves, their net worth, their net assets if they had them available. Another approach is to cut their spending as their revenues decline, to try to keep their books in the black. Finally, a third category that was a particular focus of our research was looking at the percentage of organizations that simply were not able to survive and that wound up closing their doors or perhaps merging with another organization when their revenues slowed or dried up. So the bottom line in terms of closures was during the 2004 to 2008 period, 4.2% of organizations with $50,000 or more in gross receipts in 2004 were no longer listed by the IRS as active in 2008. In short, we found around 4.2% of organizations closed their doors, as we would call it, during that 4-year period. So that still provides us with kind of a natural rate of churn or closure in the sector. Looking then at the 2008 to 2012 period, we see the rates are remarkably close. 5% of organizations that were alive in 2008 were no longer registered in 2012. Now, it remains possible that there are organizations that remain listed as active in the IRS files that are no longer active, and we'll touch upon that later. But the overall story, with or without accounting for those potentially inactive organizations, is that the sector did remarkably well through the recession. What this next slide shows is that looking at just changes in year-to-year revenue from 2006 to 2011, the impact of the recession, especially that tough period in the fall of 2008, it certainly is very, very noticeable, but it's not quite as dramatic as some would have expected. In 2006 to 2007, we saw roughly 30% of organizations showing some decline in revenue. The remainder would have had steady revenue or seen increases in revenue. In contrast, at the kind of peak of the recession, we saw, heading towards half of organizations showing declines from year to year. This next slide shows the distribution of kind of winners and losers by year during that same kind of 2006 to 2011 period. And what we see again is there's a lot of variation within the sector. Even at the recession's height, we still see 16.5% of organizations gaining 25% or more in revenue between 2008 and 2009. Now that's down somewhat substantially from a peak of 23% between 2006 and 2007, but it's still substantial. In contrast, we see nearly 17% of organizations losing more than 25% of their revenue between 2008 and 2009. In contrast, only 1 in 10 experienced similar losses in that earliest peak period. Next, we kind of break this apart by size of organization. Not terribly surprisingly, we see huge increases in the smallest categories, but as you'll see soon, we also see greater closures at that level. But that smallest category, in a sense, has sort of more room to gain. So it's not altogether surprising that we do see these a larger percentage of organizations showing a 25% or more gain at that smallest level. Many of those organizations are newer organizations that are in a growth mode, and they may also have, there may be other explanations for their increase. You'll see here that the most vulnerable categories are, in fact, this range between 100,000 and 5 million. In that 100,000 to 1 million range, which is sort of a key set of organizations that tend to be quite visible in their communities, you see 1 in 5 organizations, 20%, showed a 25% or more loss in that peak 2008 to 2009 period. Once again, you see the distribution across the subsectors, varying somewhat from sector to sector, but no enormous differences between the sectors. The strongest sectors appear to be the human services and healthcare. Some of the strength from those sectors is probably a result of our American Recovery and Reinvestment Act funding surge that the federal government put in place as a result of the recession, and those funds were typically channeled from the federal government to state government and then on to nonprofit organizations. But we think the explanations for the relative strength of the sector will vary. Now, moving to the heart of the study, let's look at a little more detail at the closure rates by subsector, both before and in the aftermath of the recession. What you see is in arts, for example, approximately 3% of organizations closed between 2004 and 2008. In contrast, in that 2008 to 2012 period, the rate increased by 1 percentage point, so it was nearly 4%. So, a significant difference, but certainly not as substantial as many would have expected. You see the same pattern across all the different subsectors, with international organizations showing the largest of the gap between the pre-recession period and the aftermath period, a gap of around 1.5 percentage points. Turning now to closure rates by size of organization, as I mentioned earlier, you definitely see higher closure rates among the largest organizations, both before and after the recession, with those closure rates hitting around 6.6% in the 2008 to 2012 period. Remarkably, you see absolutely no difference in closure rates for the organizations in the largest category, those with 10 million or more in gross receipts, and very, very little difference in the $5 to $10 million range as well. And we'd be glad to sort of open up the conversation later to talk more about possible causes and ways to think about that. Another perspective on this is to look at organizations that may have sort of fallen below the financial reporting threshold that the IRS puts in place. So organizations with less than $50,000 in gross receipts, at least at present, are required to file an e-postcard each year, but that just basically asks, are you active? And even an organization that, for practical purposes may be providing no services could potentially still complete that postcard and continue to be listed by the IRS as an active organization. So to begin to kind of tease out whether there were large numbers of those organizations that are ostensibly still alive but have fallen below that $50,000 threshold, the following table kind of teases apart this dynamic. And as you can see from the table, the percentage of organizations falling below this threshold increases dramatically in that lowest revenue category. But I think the more important number to look at is the difference between the 04 and 08 numbers and the 2008 to 2012 period. So what we see here is really about an 8 percentage point drop. So what that means in practical terms is that 8% of organizations that likely would have survived had the economy stayed strong wound up closing or becoming inactive for practical purposes than might otherwise have done so in that smallest revenue category. However, as we kind of move up the gross receipts or revenue scales, we see that the differences diminish quite dramatically. We do see some difference in that $100,000 to $500,000 range, a difference of really just a couple percentage points. And then we also see some substantial difference actually at the highest end, where the percentage drops or increases from 1 percentage point to 1.7 percentage points. But overall, we don't see a huge impact in the wake of the recession by this measure. Likewise, turning to the numbers by subsector, we do see impact across all subsectors. As you saw in the previous slide, this is really largely driven by the effect of those smaller organizations. But while there are differences, they're not huge. So as I mentioned earlier, another way that organizations may respond to declining revenues is to draw down their reserves. Now, there are a couple different explanations for why one's operating reserves might decline. One is that they are spending them down to compensate for an operating deficit in their budget. A second is that they have investments in the stock market that they are recording in their balance sheet, and that may be reflected in these numbers as well. But I would keep in mind that although we often hear about the impact of changes in endowments in the nonprofit sector, the overwhelming majority of the smaller organizations do not have endowments and do not have those kind of stock market investments that we would expect to see in these numbers. So at any rate, what these numbers show is that so pre-recession in the 2006-2007 period, we see around 3 in 10 organizations, around 31% of organizations, losing a month or more in their reserves, in their net assets, in relationship to their expenses, on average in that 2006 to 2007 period. Moving forward to the 2007-2008 period, once again, we do see increased numbers of organizations appearing to lose money in relationship to their expenses, or see declines in their net assets in relationship to their expenditures. But it's not as dramatic as one might have expected. In the 2007 to 2008 period, that number is still only around 38%, a little under 40%. And, in contrast, we see the number of organizations gaining at least a month's worth of net assets as measured in months of expenses, declining from around 1 in 3 in that kind of base year of 2006 to 2007 to around 1 1/4 between 2007 and 2008. So finally, let me wrap it up by one more look at the impact of those changes in reserves. What we see here is, once again, very little change among those smallest organizations, which, again, is consistent with the perspective that, they probably had very little reserves to begin with. They had very little, certainly invested in the stock market, so they would not see those declines in reserves reflected on their books across the years. The most dramatic change is between 2008 and 2009 among the largest organizations. Once again, this could be a combination of both declines in stock market valuations, as well as deficit spending to maintain their services, even in the face of declining revenues. So with that, let me turn the presentation over to Una, who will talk about financial literacy.
Wonderful. Well, thank you so much, Tom. It's a pleasure to be part of this discussion, and I'm really pleased to have this landscape for us prior to launching into our own study. As Tom has introduced the overall events of the 2008 Great Recession and how that affected the nonprofit sector, our job is actually to provide an in-depth view of how nonprofits responded to the recession. We had the opportunity and actually the privilege to partner with the Moody's Foundation, as well as a national team of researchers and practitioners, to launch the first study of nonprofit financial literacy. The study had 3 main goals. The first was actually, for the first time, to provide a baseline of the financial and economic literacy of nonprofit leaders, managers, and executives, and also to determine, during the recession and in its aftermath, what types of financial and economic indicators nonprofit managers were using to make their financial decisions. And finally, our hope and our vision was that this study would provide a catalyst for more discussion and research on financial literacy within the nonprofit sector. So the next slide actually provides a bit of motivation. Why study financial literacy? Tom actually alluded to this a little bit when he said at the start of the Great Recession, many predicted that the recession would induce financial and economic challenges for many nonprofits. And even some analysts predicted a decline in the nonprofit sector during this period. At the same time, we know that over the past 2 decades, there has been a growing wealth of economic and financial data that nonprofits can use to perhaps improve decision-making within the sector. Before I go any further, I guess it's also important to mention that the nonprofit sector plays a very vital role in the functioning of U.S. economic and social and civic life. And so the health and strength of the nonprofit sector is critical to many of our communities and many of the social services that we provide, as well as part of building a better community for so many of us. And so the reason this study is actually to emphasize its importance, the Great Recession induced many significant economic challenges. And so the question we're going to ask here, following Tom's question, is how did nonprofits navigate those difficult economic times, and what results and insights emerge from this study? Okay, the next slide, before we go any further, I'd like to just touch on what we mean by financial literacy. This is a term that we're going to use throughout the presentation, and I thought it might help us just to provide a brief definition. We define financial literacy for the purposes of this study as the knowledge and skills of basic economic and financial concepts, as well as the ability to apply them to financial decision-making. What we know is that nonprofit professionals have vast knowledge of program design, they have vast knowledge of service delivery, and often fundraising. What we don't know is whether they've had exposure to economics, to courses on finance, and how they have weathered the storm, essentially, during and after the Great Recession. We also know across the economy that there are conversations taking place about how we can infuse a greater degree and depth of financial knowledge into consumer behavior, into firm behavior, and so I think this is a really critical moment to talk about this for the nonprofit sector. Now, before we go to the results, I'd like to touch on methodology here just for a few minutes.
The study that you're going to hear the results from is actually a national study of nonprofits. We focused on organizations that had an annual revenue of between 100,000 and 100 million. Now, keep in mind this does overlay with some of the data that Tom presented, because we're looking at relatively medium-sized organizations, not the smallest organizations, not organizations below 50,000. And you'll hear more about the sort of middle of the distribution, which is where the bulk of the nonprofit sector resides. Our study actually does not include higher education, hospitals, or international nonprofits. We deliberately excluded them from the study in order to get a bigger sampling of these other organizations. In terms of timing, the study was conducted in 2010, so right after the Great Recession, in the beginning of what we now know to be the recovery, but during that period we did not know exactly whether the recession had ended. In terms of the final sample size, we have a relatively large sample of over 500 organizations located throughout the United States, and the picture that you'll see is one of much heterogeneity in how organizations responded to the recession. All right, the next slide actually shows a similar view to what Tom presented, so very much consistent with what we've seen so far. When we look at organizations referring to the depth of the Great Recession, we see that about 30% said that their donations received more or less held steady, while about 70%, so a majority, experienced some kind of change. What surprised us, however, is that not all organizations reported a decline. When we added up the organizations that experienced a decrease, it was about 30%, while actually the majority, almost 40%, experienced some kind of increase. Now, what we saw during the recession is a wide variety of outcomes. Some organizations actually encountered stable donations during this period. Some saw a decline, but what surprised us most was that some actually saw an increase. And that's very, very interesting for those of us that are studying this and those of us who are also working with nonprofits, because it shows us that even in the most dramatic economic decline of this century, of the first half of this period, that we are actually seeing organizations doing quite well. Okay. In terms of what these organizations look like, I think it's important to note that many organizations derive revenue from a variety of sources. Another important point to note, and if you look at the first bar on the chart, you'll notice that almost a third of revenue comes from government sources. And I think this also fits in very much with Tom's point that federal revenue, state revenue sources played an important role in helping nonprofits navigate the economic challenges of the Great Recession. We also note across the subsectors that organizations rely to a varying degree on private donations as well as earned income, corporate support, and foundation support. So the basic message from this slide is the heterogeneity of sources of income for organizations in our sample. Okay. Now, what I've presented so far is a profile of the organizations we studied, where they got their income from, how their donations changed during the Great Recession, as well as how they appear to have weathered the storm. What I'd like to talk about next are perhaps some of the first insights about self-reported level of knowledge within our sample. So we asked nonprofits, and I don't think this question's ever been asked before, so you're seeing data that no one else has had access to prior to this study. We asked nonprofits to rate themselves on their degree of financial knowledge and their level of knowledge about financial management practices. What actually emerged from this study is that most nonprofit leaders actually feel relatively knowledgeable. More than 3/4 reported themselves to be knowledgeable. What we see, however, is that many still regard themselves as novices in this area. So there is an opportunity for more work to better understand this, what it means to be a novice. And actually only a small fraction report themselves as expert. We see some variation across subsectors. We also see some variation by size. As you can imagine, larger nonprofits are more likely to report that they're knowledgeable, and smaller nonprofits are more likely to report that they're novices in this area. So it's hard to say that we have done our job now and we can all go home. We certainly see variation here. Some are certainly reporting expert levels of knowledge, with education perhaps being where we see the highest fraction of respondents saying that they're novices in this area. All right. Now, we did a deeper dive into this question of expertise and level of knowledge, and I just want to point out that where there appear to be the biggest gaps in knowledge are around two areas that have gotten a lot of attention during the Great Recession. I just want to highlight those because we can come back to those during the discussion section. First, nonprofit leaders do not appear to be very knowledgeable in the area of collaboration and merger analysis, and I do think that's an important point because Tom touched on that could be a response to the recession and to reduced sources of revenue. We also saw relative gaps in knowledge around debt restructuring, with only 51%, nearly half of the sample, more than half of the sample, saying that there were novices in this area. Where we saw individuals and nonprofits reporting expertise, it was around issues like internal policies, strategic planning, and cash flow projections. Those were where we saw a lot of individuals reporting expertise in those areas. Now, one other piece of knowledge that emerged from this study, and again, I'm presenting what we thought were most interesting and really important takeaways from the study. Our first finding that we actually shared with our advisory council when we finished the initial analysis was that nonprofits had changed their financial objectives during the recession, at least it appeared to. This study was the first to show that nonprofits were targeting cash reserves and flexibility in cash reserves as their number one financial objective. Studies in the past have found that nonprofits have emphasized breaking even financially or other goals, avoiding financial risk, minimizing costs, or in some cases, maximizing net donations. This was the first study, to our knowledge, to show that maintaining a target level of cash reserves and flexibility in those reserves was a primary objective for many nonprofits. You'll see that 38% of respondents said that was their number one objective, 27% discussed an annual surplus as a goal, and only 24% suggested break even was a goal for their organization. The next slide is really a reflection for those of you on the call. We'd like you to just think about how your organization managed or navigated the Great Recession and what strategies you might have employed, because we did see a range of responses, and you'll hear more about this during the course of the webinar. All right. What we saw most in our sample is that organizations chose to cut spending. So Tom suggested that nonprofits weather this storm actually remarkably well. And what we saw is how did they do that? Most organizations used the strategies that involved reducing spending, reviewing their priorities, and changing their programs. In some cases, less often, reducing personnel and postponing technology expenditures. We also saw that one tactic that was used by organizations was delaying capital projects. We did see organizations rate some tactics as ineffective, and they discussed specifically eliminating endowment spending, drawing more from endowment, securing lines of credit, merging, and increasing secondary sources of income as less effective in navigating the Great Recession. Now, turning to a very important component of Tom's presentation, the idea of operating expenses and cash reserves. This is an area that actually sparks a lot of controversy because there's a question of what is the appropriate level of cash reserves. And we know that there isn't a set level that's required by any law, and certainly this has to be tailored to the needs of that nonprofit. But what we found in this study that was quite surprising is that more than half of our sample, these are medium-sized nonprofits, not the small nonprofits that Tom actually highlighted, had less than 3 months of cash reserves. What we saw is in some cases, they had less than a month of cash reserves. Now, this is also a conversation that we can extend beyond nonprofits to consumers, small businesses, and firms and ask what is the appropriate level. So it's one we could come back to during our discussion because it's certainly an area that we spent a lot of time trying to analyze, but realized that with half of our sample reporting relatively low levels of cash reserves, this did raise questions about how nonprofits would navigate the recovery itself and their ability to expand or to meet needs during very difficult economic times. All right. As we continued our study, one of the other big insights that came out of looking at this cash reserves question is that there was significant variation by subsector. In particular, arts and culture organizations appear to be relatively vulnerable, with very few of them having more than 7 months of cash reserves, and more than almost 60% saying they had less than 3 months. So we did see variation even within the subsamples by subsector and by size. Smaller organizations reported much more vulnerability when we looked at operating expenses available in cash. As we finalize the webinar, I just wanted to pose one more quick reflection question for the audience. I wanted to ask you very quickly what indicators your organization currently uses in financial decision making. We were very interested in this question because there's a growing wealth of data that's available to nonprofit leaders that wasn't available 10 years ago, maybe even 20 years ago, and much of this can be customized by region, by location. And so as we turn to the next few slides, I'd like to show you what our sample actually uses on a regular basis in making financial and programmatic decisions. By far the most important indicators that are used are indicators about charitable giving and indicators about inflation and poverty. We did not see as much use of other benchmarking indicators, and certainly we did not see a lot of use of even national indicators. For example, use of tax data, S&P index, and other indicators that we thought might be used within the nonprofit sector. So this does raise a question about what would be the right indicators, what indicators would actually be attractive to nonprofit leaders and decision makers as we move forward. As we look by size and subsector, we do see some variation. Some subsectors are using indicators more, and some are relying on national measures more so than others. And I just want to point out, we grouped the civic and environmental subsector because they appear to be using far more of these data sources than some of the other subsectors. And in the interest of time, I'm also just going to show you very quickly the arts subsector, where we did see, again, not a lot of use of data on the programmatic side. So much more use on financial decision-making, less use of data on actually determining programmatic outcomes and priorities. I'm going to just try to wrap up here and mention that there are various indicators that can be available to nonprofits as they seek to make decisions, and we have listed them on this slide. This will be available to those of you who want to delve more into this information later. As we summarize our results, one last point that again came up during the recession is that one motivation for financial literacy and financial knowledge is to prevent fraud and to prevent its occurrence. And so this raised the question, how many organizations have actually been victims of fraud, and what do they attribute this fraud? Why did they experience this fraud? What we found is 83% of our sample had not experienced fraud, with only 17% saying that they had actually experienced fraud at their organization. What was interesting from the standpoint of the study is that many of the respondents actually cited lack of proper oversight and proper procedures as the number one reason for the fraud, but they also cited lack of proper financial practices and good management practices as another reason for fraud occurring at organizations as well. All right, as we close, we started this study with the goal of elevating the discussion on financial literacy and knowledge and bringing it to the nonprofit sector. We also wanted to spur the use of more data, more use of financial indicators in terms of helping organizations use what's available to make decisions for their own programs. And so as we think about what the implications of the study is, we'd like to open it up to all of you who are on the call to send in your questions. We'd like to know what types of issues have emerged. And we'd like to also, if possible, please put your questions on the chat window. And we have already seen a number of them come in, and we'd be very happy to start answering them just as soon as we receive them. I've written down a couple that have already come into our discussion. So the floor is open. I did already know two questions that came in. One participant asked specifically about the housing sector. Nonprofits located within housing, what were their experiences during the Great Recession? Did they experience different outcomes? Did they have higher closure rates? And I thought maybe Tom could touch on that because he might know specifically what happened in it's a sort of subcomponent.
Right.
Yes.
Yeah. The housing subsector is lumped under our larger human service sector. Offhand, I don't know, but if you send us your email or if you just send it to nccs@urban.org, we'd be glad to get you that information.
Okay. Another participant had a relatively technical question, so I just wanted to jump in here as well and ask, this is directed at Tom, but I can also talk on this as well, how those thresholds were chosen. So your slide sort of picked 50,000 to 100,000 and also lump a bigger group together. So I guess the participant wanted to better understand the distribution and how those thresholds and margins were selected.
Well, the 50,000 group, I mean, we're limited by what the IRS data can provide to us. So organizations with less than $50,000 simply are not required to report on their finances. Many do, but the percentage is just too small to make it a really viable collection. You know, the other ranges were picked, you know, based on sort of our, you know, long experience conducting sort of analysis of nonprofit organizations. I confess it is probably more art than science. I think that's the only response I can offer.
Well, I did see one question on effective versus ineffective strategies. And I will try to touch on that, but I'll also ask Tom and some of my other colleagues here to share. Now, our question was actually self-reported. We asked organizations, during the depth of the Great Recession, what strategies did your organization employ, and to what degree did you think they were effective? So first, they had to point out the strategies that were employed, and then they had to rate them based on how their organization fared during that recessionary period based on the strategies that were used. So for example, drawing down reserves, reducing staff, reducing program priorities, how effective were those in helping the organization meet its goals while navigating the economic challenges that were facing that organization? So we didn't actually determine whether those were effective or ineffective. We asked the respondents to tell us their own experiences. And so what was, I think, interesting but also quite surprising is that the strategies that were chosen in terms of effective turned out to be things that involved reducing the scope of programs often, reducing the scope of work that the organization was doing, prioritizing in different areas. And what respondents gauged to be less effective were things around endowment, drawing down endowment, changing endowment spending. And so I think that's a really interesting area for further research, but also reflection, why some strategies are seen as effective, but some less so. Tom, I don't know if you
I would just add, I mean, I think the key finding of the study is it certainly appears that organizations were proactive in their management of their finances. I mean, the low closure rates, I think, speak to the the sensible management in the sector. I think that's a very strong finding here. I think it is difficult to generalize across such a wide range of types of organizations with differing levels of reserves and different options available to them. I think the bottom line is if you are proactive, you're likely to survive. If you're not, you're likely to get caught among that 5% of organizations that don't survive.
Right. So, yes, Nathan.
Well, yeah, could I just add, I think that now is the right time to try to answer these questions. I remember seeing organizations try to answer these questions right after the recession ended, and it was hard to tell. I think it was hard for them to tell what was effective because they had just come out of the experience. Now that some time has passed, we know whether the short-term stopgap solutions that some organizations adopted actually did them good in the long run on balance. And which strategies that got them through the immediate crisis didn't end up doing them any favors in the long run.
Very good. One other question that was raised, which is also a very important one, is to touch on the regional and state level differences. Now, within our study of financial literacy and financial knowledge, we did not see vast differences by region and by state. But I do want to ask Tom to jump in because there may be differences in how closure rates as well as cash reserves by region and by state, because we know that the recession had a differential impact on different parts of the country.
Yeah, we did not focus on regional differences in this study, but once again, we'd be happy to share some tables with you that we can run over the next week if you send us your email.
Okay, we have a number of other questions, and I'm going to sort of lump them together, and then we'll have some closing remarks very shortly. We did include hospitals in the work that Tom did, as well as religious organizations. In the study of financial literacy, hospitals were excluded because in general they have quite sophisticated financial practices and management, and so they were not included in our study of financial literacy. Religious organizations were also not included. That would be an extension of the work we did to expand it to those types of organizations. I think there's one last question that we might want to touch on, and that is, although organizations may not have closed, they may have changed their position in the distribution, dropped from 1 million and above to a smaller category. So I don't know if we have any data on that, or if anyone can speak to that very quickly.
Well, I know, but I'm not sure it's in the presentation. I know we have some information about organizations that gained or lost significant amounts of their starting revenue.
Yeah, essentially those charts that show the percentage of organizations losing 25% or more of their revenue, I think, so to capture that dynamic. And you know, as you can see, there are substantial numbers that did show those substantial losses.
Well, as we're closing in on the 1 o'clock period, I'd like to now say thank you to all of you for joining. It's certainly been a pleasure, and we look forward to having you on the rest of the series. I'd like to turn it over to the president of the Moody's Foundation to end our webinar for today.
Thank you. After today's webinar, you will receive a follow-up email with a link to view a recording of today's webinar and the PowerPoint, along with a short survey on the presentation. Notwithstanding our technical difficulties, we would really appreciate it if you would complete that survey and send us your feedback. Your evaluation will be very helpful to us. So on behalf of the Moody's Foundation, the Urban Institute's National Center for Charitable Statistics, the Lilly Family School of Philanthropy at Indiana University, and our presenters, thank you for joining us today, and have a great rest of your day.